Hey, have you ever wondered how much house you could buy with a VA loan? In this video, I'm going to show you that and much more. Hey everybody, welcome to my channel. I am your host, Leo Landaverde, business coach and real estate investor, helping you scale your business. If you're ready to grow your business to 7 figures and beyond while creating the financial freedom and the lifestyle you want, then subscribe to my channel and don't forget to hit the bell and you'll be notified every Thursday when a new video comes out. Last week, we discussed the minimum mortgage requirements for a variety of loans. We talked about FHA loans, VA loans, conventional loans, and USDA loans. So how much house can you get with a VA loan? Well, the good news is that you can get much more home with a VA loan than any other loan. So here are 5 things you need to know about VA loans that could help you qualify. So let's get to it. Number 1, basic eligibility requirements. First of all, VA loans come from the U.S. Department of Veterans Affairs. So here's what you need to know that will help you qualify. You must be a veteran who served 181 days during peacetime on inactive duty, or you must be a veteran who served 90 days during wartime, also in active duty, or you could have served at least 6 years in the National Guard or reserves, or you're currently in active duty and have served at least 90 continuous days, or you were discharged from the military due to hardship, and lastly, you are an unwedded spouse of a veteran who died while in service of this country. Number 2, credit scores. The VA does not have a specific credit score requirement. However, most lenders do, and they're going to be looking at you having a score no less than 620. So they want you to have a FICO score of 620 or higher. The higher, the better. Now, I went into a whole lot of detail in last week's video, so I suggest you watch that video because I break it down on a grid, and the video will be right here and on the screen. Just click on it. But don't get too caught up on the FICO just yet because it's a kind of a balanced score on everything that you're gonna represent. Number 3, debt ratios. There are 2 ratios that you should be concerned about when getting a VA loan. One is the front end ratio, which is before you get a VA loan, and the other one is the back end ratio once you get a VA loan. Generally speaking, your debt to income ratio for a VA loan should not exceed 41%. Now keep in mind that this is not a requirement from the VA, but it is imposed by the lenders. So long as you remember, and I'm gonna go over it, and when we look at the spreadsheet, just hang on because I'm gonna show you what that looks like in a couple minutes. But so long as you remember that your back end ratio after your VA mortgage cannot be more than 41%. So one more thing to remember about VA loans is that they care not just much as that your back-end ratio is 41% or less, but they also want to know how much disposable income you have after you pay all your debts. Now, that thing is called residual income. And I'm going to go specifically in more details to show you because it's easier to show you on the screen. So hang on, I'm going to show you that in a couple minutes. Number 4, mortgage documents. When it comes to a VA home loan, documentation is key. Remember, you're dealing with the federal government. So I'm going to read to you a list of documents that you're probably going to need to have ready. Okay? So 1 is a certificate of liability. 2, the Uniform Residential Loan Application, the URLA. Number 3, you're going to need bank statements. 4, you're going to need tax returns. I usually like to ask people to have at least 3 years worth of tax returns. You may only need 2, but 3 is better. You're going to need your W-2 forms if you are an employee. And if you are self-employed, you're gonna need your income statements, your profit and loss, your Schedule C. You're also gonna have to provide the DD Form 214 for veterans who have left the military. This is the paperwork related to the VA, plus other documents as requested by the VA. Number 5, occupancy. And this is a very important one. The VA loan can only be used to get a primary residence, which means that you have to live on the premises. That means that you cannot use this loan for a second home, for an investment property, for a fix and flip, for a vacation rental, none of that. You have to live in the property. Now, if you say you're gonna live in the property and you later don't, you may get into trouble. Remember, this is a federal loan. You don't wanna mess with it. Now let's hop over to my computer and I'm gonna show you how it all comes together. So let's do it. Okay, now we get into the fun part. This is the part I like, calculating the numbers. So there are 3 things you need to keep in mind. 3 numbers I want you to look at as we're calculating this. And there are notes right next to them. The notes are in red, so they stick out. And if you want this worksheet, I'd be happy to give it to you. It's just a very simple way to illustrate the calculations. But number 1, we already said that the debt to income ratio cannot exceed 41% for a VA loan. So if it exceeds over 41%, then you have to have a residual income that is at least 120%. Now, the residual income is right here. For this illustration, our residual income is $1,400. $1,416 and 67. So residual income for in the Midwest, a U.S. family of 4, a family of 4 would typically have about $1,000 left. That is acceptable. But however, if your DTI exceeds 41%, that requirement gets to increase to 120%. So it really is based on data available that the VA has across the country. So if you are in the western states, if you're in California, if you're in New York, your disposable income requirements will be different than if you are in the Midwest or the South. So this is already hardwired. It could be higher, it could be 45%. And you're gonna notice that when I change the 41% to 45%, your residual income, it decreases, back to 41%. And it increases, right? So we are also using the average annual salary based on 2019 data, which is $50,000. This is the suggested debt to income ratio, which is where you should be. So bottom line is, no matter what the lender will allow, including the VA, which by the way, the VA has the lowest back-end ratio, you should be lower than that, because it's not how much money you pay, it's how much money you get to keep for food and the rest. So the VA is saying 41, you should be at least 35% or lower. We're not gonna get into the take-home pay. Actually, this illustration is for employed W-2 people, because it takes the gross, not the net. Now, if you were self-employed, then you have to go off the net, which would mean you're a Schedule C. If you're self-employed, if you're a sole proprietorship, you would have a Schedule C that feeds into your 1040, which you would have self-employment tax. That's a whole conversation, another conversation for another day. So this is just about people who are gainfully employed and get a W-2 at the end of the year. $50,000 translate, if you take that, works out to be $41, $66, and $67 per month gross. So what is the formula? So we're gonna take our monthly income and we're gonna multiply it by the maximum allowed debt to income ratio. It's 41%. Then we're gonna subtract your debt load monthly. This debt load comes from your credit report. It doesn't come, the lender will take your credit report, which they will pull, and they will look at your FICO, which will tell them about your credit worthiness. They're also gonna add up all the minimum payments. So this is kind of where it comes from. So say, this as in this example, say you have a $325 a month car payment, which is, pretty rare, actually pretty normal, pretty common to have at least one car payment, and the average person will have 2 credit cards. So there's one credit card payment at 70, one credit card at 100, and there's something unique to the VA loans that they would actually want you to build in an estimation for utilities, which doesn't happen with FHA, it doesn't happen with USDA, and definitely doesn't happen with conventional loans. It's only unique to the VA. So we have this person right here has $695 worth of monthly debt, including the utilities. Okay, so at $50,000, your max mortgage payment cannot exceed $1,013 per month, and that is principal, interest, taxes, and insurance. So PITI, principal, interest, taxes, and insurance, right? And this is your property taxes. So that means that in this case, we are okay because we have at least $1,000 per month of disposable income, which the VA factors would be good enough for you to take care of your expenses. Remember, some of you have, depending on how age you are, you're gonna have higher car insurance or lower car insurance. Maybe you wanna have renter's insurance. Maybe you want to have other types of insurances to make sure that you're going to be taken care of. And it's about making sure that your family is protected. So that makes any sense. Now let's change things up a little bit. Say we're at a higher bracket and you were at a $60,000 a year salary, and all of a sudden your maximum mortgage payment, and assuming that everything else was the same, so if the only variable that changed was you actually made more money, which means you can have a higher mortgage payments, which allows you to buy more home. Notice what happens to our residual income went up to $1,700 because the more money you make, and there is more to go around. Okay, what happens if you make $70,000 a year, right? And this is combined, so this takes a combined household. So this is a husband and wife. If you're applying jointly, that will combine your both of your wages, right? So if your combined wages are $70,000, all of a sudden you can afford more home, right? And keep in mind that with a VA loan, you don't have to make a down payment. So keep that in mind. You don't have to make a down payment, right? With FHA, you can make a 3%. At the least you can make it at 3%. Of course, you want to pay the more money you put down, the lesser the mortgage that you're going to have. So it all comes together. And I'm going to show you in Zillow. So hang on for a second. I'm just going to show you what that looks like in just a minute. So, and so forth and so on. So if you actually made more, if your combined household income was $80,000, now you can have a max mortgage payment $2,038 and 33 PITI. Now, am I encouraging you to get as big of a mortgage as you can? That's your decision, right? Only you know how much you can bear. But I hope this helps you. Now let's hop over to Zillow and see what that looks like. Let's go shopping for some houses. All right. Now let's do some house shopping. So if you remember, we just calculated the maximum mortgage payment that we can have on a $50,000 a year salary. Okay, and we're gonna make a few variations, but so here we are. We're at Trulia, and actually Trulia, it's actually pretty good. You can do it in Trulia and you can do it in Zillow, but I'm gonna do it in Trulia this time. So everything starts at 0 right now, so we're gonna start pre-fill some of this information. Now, keep in mind that I live in the Central Valley, California, where prices are a little higher than some other parts of the country. So there are some assumptions we're gonna make. Now, I'm putting a zip code, and this zip code is just for local tax and interest rate. But I'm using the 93611 zip code, and say we're gonna start at around, 250. Okay, right away. We have a $1,474 payment. Can we afford that house with putting no money down? Actually, the interest rate is correct, but can we afford this house without any money down? No, according to VA guidelines, right? Because our back-end ratio would exceed the 41%. So we have to put some money down. So how much money down? Watch as this, kind of moves around. We are going to, if we put 10% down, which is, if we put 10,000, which would be 4% down, it's still not enough to bring us that to where we need to be. So how much money will you have to put down in order to bring you to the what? 1,013. You would have to put down a whole lot of money, almost 20% down. Well, the good news on putting 20% down, which is a little bit unrealistic, is that even though your down payment would be 20%, you still have a $200,000 loan plus closing costs. I mean, it would be ideal, which means that you could pay off your house sooner, but is it attainable? Probably not. So now we're starting to realize that you may not be able to get a $250,000 home, even with a 2.49 30-year fixed, without something, you need more, either you need less house or you need more income. Because this is kind of what it's like. So say let's change some things around. Say you actually made more money. Say that you actually made $60,000. Okay. Now all of a sudden we can actually afford a $1,355. Now we can actually do some more shopping. So say we wanted more house. So we're gonna go to, what is it? $1,355. So you can go to $285,000. We don't want to pay that much. So we say we have $25,000. So you have $25,000 and you have a $285,000 home, and your payment PITI in what you need is $1,503, and we are at $1,355. which is still a little high, which means that you have to put more money down. Keep in mind, this is just one person at $50,000. Most people who buy will have dual income. It will be a husband and wife. It will be two people buying a house. But so 50,000 income a year doesn't really give us a lot of house in California. We're at 285 right now, and we have $30,000 down, and we still have the best rate, and we are at 1444, which would be a problem because we couldn't afford it, because we would have a problem with the back end ratio. Remember, cannot exceed 41%. We have to be 1355 or less. So what do we need to be at? We need to be at around 265 and $30,000 down. Okay, so that would make it up to about 11% down payment, $265,000 home, and assuming that your FICO is at least 620. So let's increase the income. Say you have together, now you have a husband and wife, or brother and sister, two people, combined income of 80,000, which brings us to 600,666. Well, it's not a fun number. It's a lot of sixes, 5 sixes. So you still have, and of course, I forgot to tell you that these are variables, right? You may have a less car payment, you have a higher car payment. If you have less debt, which means you can actually afford more loans. So, you see how the variables kind of play. You have to play around with the variables, but you don't need to do that before you go shopping. So now we can go up to $2,038 mortgage payment. Okay, now let's see what that looks like. Okay, it's $2,038, which means that we can go up to right around $390, $385, 2038. We could actually get a $385,000 home with a 7% down payment. Now, disclaimer. Now, this is strictly down payment. This does not include closing costs. Closing costs will save you back anywhere from 7 to 10% of the actual transaction that you need to have set aside in cash. So that's something that you need to know. Regardless of your credit, you still need two types of money. You're going to need the down payment and the closing costs. Now, you may get some credits from the seller on the closing costs, but you have to assume that you're going to put 100% of your closing costs. Now, you can actually get a $385,000 home. That's pretty cool. All right, so let's say your combined income goes to up to $90,000. Now we're talking $2,380. Puts us around the $440,000 price range for properties. So what I suggest is you work the numbers, get pre-qualified with a lender, then call the realtor or find a realtor, and once you pre-qualify, this is like you're ready to buy. So I hope that makes sense. Please check out my other videos, and I hope that you find it useful. Thank you so much for letting me share.
Are you currently in the market for a new home? Interest rates are at historic lows, actually in the mid-2s. If you are interested, shoot me an email. My email address is in the description of this video below. Also, if you want to join a community of like-minded successful entrepreneurs just like you, then join our Facebook group. The link is below, where I share weekly tips, tactics, and strategies on how my clients are growing their businesses to 7 figures and beyond.